Good morning, New York, San Francisco. Jeez, I always botch these intros. What's up, everyone? This is the HIG Podcast. I am MattyP here at the Harris Financial Center in Provo, Utah, alongside with my friend, my buddy, my good pal, the man with the master plan. I think that was part of your intro last time, Bronson Kaufusi. What's up, Bronson?
Hey, what's going on, everybody? Good to be here.
And as always, we have a very special guest here with us today. We love when we can, our special guest is Matt Denning. We love when we can pin him down because he's a busy guy.
It's a little uncomfortable being stapled down like this.
Hey, you know, we do what we got to do. I know you've been closing deals and been here and there and talking to people and been on the phone pretty much for the last, I think, like 2 months straight. And you're a busy guy. So we really appreciate your time here. So there's kind of a new thing that we do here, Matt.
Tell me more.
It's we have a series of questions that we are asking some of our regular guests just to kind of help our investor base know a little bit more about us, get to know a little bit more specifically about you. And it's basically 5 favorites with Matt Denning today. The way that this little game works is I have just 5 topics, and it's your top in each topic. So first one, what's your favorite car?
I'm not a big car guy, actually. My wife always wanted a Dodge Viper.
Those are cool. So you defaulted to the wife.
She runs the house and rules my world. Whatever she wants is what we talk about.
You know what she wants?
That's not where we were going with that?
That's a good answer, though. What's your favorite snack?
Well, I'm a sweets guy more than a salty guy, although I do enjoy chips and the like, but I enjoy dark chocolate.
Cool.
Yeah.
Dark chocolate's good.
It's the healthy stuff. It really is.
It
really is the healthy stuff.
Right. Healthy fats when you eat 20 pounds of it.
It's just like avocados.
That's right, exactly.
Avocados.
That's right.
What is your favorite travel destination?
That's a great question. I've been to some neat places. I do like Rio de Janeiro.
Oh, cool.
Never been there?
Yeah, Rio's neat. There are a lot of places I've gone to that I say, you know, we've got that in the United States. Rio is one of the few exceptions, although we do have Hawaii.
Yeah, I have been there. I do love Hawaii, but never Rio. 4th question. What is your biggest motivator, or who is your biggest mentor? You can choose either or.
Well, my family motivates me. I am a Christ-centered individual, and so there is the religious element of that. And I've been fortunate enough to work with some great people in my life from a mentorship perspective, and have learned some great lessons from some of my previous business partners. It would take a whole podcast to go through that list of individuals.
All right. Lastly, and this is one you can answer at the end of the show if you don't have one right off the top of your head. It's your favorite maxim.
Come on, give us something like East Coast on this. Dude,
Kyle pulled one out. I was so surprised.
He did have a good
He had one at the top of his mind.
Every decision has a consequence. Can I say that for my kids?
Yeah, every decision
there you
has a
go.
consequence. That's a good one.
That's one in the Denning household right there. You're saying that one since they were little.
That is. Yes, I do.
It's a life lesson right there.
Yes, I do.
It's interesting because even when you have that choice or when you have to make a decision and you don't, there's still a consequence. There's always a consequence. That's deep, man. I like it. Well, believe it or not, this is episode 33 of this podcast. Of this
Congrats, guys.
The double 3. I think probably the best way that we can really follow up my awesome list of 5 random questions is a listener question that we got from someone who's not a stranger to me, but someone who has been asking me a lot lately. It's my wife, Jen. I told her that you were going to be on the show, Matt. She wanted to know, will Jerome Powell ever lower the interest rates?
Yes, at some point he will.
It's bound to happen, right?
It seemingly is going to happen here soon. There's a couple of considerations. There are multiple considerations there. The biggest conversation, and we've talked about this a little bit before, of which I nor others know, is what is the long-term stable interest rate? And so when you think about the fact that markets are cyclical, the conversation is, well, what are they revolving? What are they gyrating around? What is the mean, the benchmark? You know, what is that number? So there is the chance that the number is 4 or 4.25% is right where we're at right now. And an argument could be made then, if that's the case, then maybe there aren't cuts that are coming in the near term. More of the conversation, though, right now is obviously around inflation and economic data and how that would impact interest rates. Most feel like the long-term average rate, the normal rate, should be lower than what it is today. And it feels like we're still in that reversion to the mean, with the rates coming back in. And so there's obviously a strong consensus in the market by the Federal Reserve themselves that interest rates will be lower by the end of the year. It's just a question of when, not if. But there are some things that could derail that.
It's kind of changing the...
It's crazy how much that really that affects the landscape of real estate.
Oh yeah, it plays a major role, in a lot of areas. And I think that's what a lot of people want to know about is, okay, if that happens, rates come down, how does that affect what we do here?
Well, being real estate investors, we're constantly thinking about our financing costs. And so it would, all else equal, help our financing costs. Now, many think and say, well, if rates come down, then that'll be a positive for us. But as we've talked about before on this podcast, that we have to understand what asset we're buying and what benchmark the lender is deriving their rates from. Certain lenders derive their rates from the overnight rate, or from what we talk about, what most people talk about when they say interest rates. They're thinking about the Federal Reserve rate, the Fed funds rate. They're thinking about overnight rates. Most lenders in the commercial space, they do not price off of the overnight rate, right? Mm-hmm. Many are pricing off of 5-year, 7-year, or 10-year bonds. Your mortgage that you obtain as a consumer on your home, that's priced off of the 10-year bond. Your 30-year mortgage typically is most correlated to 10-year bonds, because we talk about a concept of duration. So how long is the average hold period of that loan? And that's the interest rate duration that it's based off of. But there are lenders that do lend on overnight on Fed funds rates. There are certain loans that do that. In the real estate space, there are bridge lenders which do that. And so if you rolled the clock back 5 years ago, those bridge lenders were offering the most attractive interest rates, as they were referencing a Fed funds rate that was near zero. And the 10-year bond was perhaps at 1 or 1.25% back in those days, which just seems like an incredibly low rate as we talk about it today. And so you had the overnight rates that were lower than the 10-year rates. Well, for the past 2 or 3 years, it's been the opposite. But now we talk about that equilibrium where all else being equal, the overnight rate should be lower than the 10-year rate. You should be paid more money for a longer duration bond. And so, Matt, going back to your question that you asked in the beginning, another reason why there's a general consensus that interest rates should come down is because of the yield curve and how it is structured. And when we talk about that, we talk about the different durations, or 1 year versus 3 year versus 5 year Treasury, 10-year, and it's been a little bit out of whack. It's been inverted. It's been smiling. There are different shapes that it's taken, but none of the shapes over the past while are normal, sustainable shapes, so to speak. The normal shape that we all expect is overnight rates are the lowest of all, and the 10 and 20 year or 30 year bonds are higher, as you go out on that yield curve. So we're looking forward to rates coming down. It will have some impact on our financing. We've already seen some benefit from the 10-year and 5-year rates that have come in over the past 6 months. So even without the Federal Reserve not having changed rates, we're seeing a positive benefit lately in interest rates. Bronson, though, you've also heard us, we've talked about other indicators. It's not just the interest rate that impacts pricing of loans, or it's not just the reference benchmark interest rates. Another big deal is volatility in the markets and that risk premium that gets thrown on there. If you were to look at volatility in the equity and bond markets, they are meaningfully lower today than they were back in Q2. I think that April is probably the peak this year of that volatility, and it's absolutely correlated with tariffs and all of the rhetoric from that and what would happen. But volatility is way down. And so that's another positive that we have on the financing side of the market. It's a little surprising that we haven't seen the lending market loosen up a little bit more, just given what's happened with interest rate expectations and also with bond market volatility. I would have thought we'd be a little bit lower in some of the rates that we're getting quoted today, but it's trending in the right direction, and it's encouraging to us that it will provide better opportunities, better return profiles for our investments going forward.
Yeah, it's huge too, because when you talk about winning on the buy, people say that all the time in real estate, and it's, you got to win on the financing piece. Like you have to win, and that's it's a huge part of everything that we do here.
Yeah.
So it's fun to hear, kind of in depth what that picture looks like right now.
Yeah.
And so, but you did bring up a good point about, there's other things that come into play in that lending, kind of space over here. Maybe you could touch on, another area besides the stuff that you've said already, but then also just looking at, with what we do here at Harris Investment Group, how that plays for us going into Q4, because, Q4 is kind of a big deal here. There's always a lot going on. So.
Yeah, there is. And you talked about what impacts returns. The entry price is obviously a big deal. It's what is the purchase price of the asset. And whereas with interest rates, you can get an opportunity to reset, to refinance, right, into different debt. There's only one entry price that you buy an asset at. You can't redo that.
Yeah.
And so sometimes we're willing to buy things at a price that may seem a little bit out of whack because of how interest rates have impacted the purchase price, but then knowing we may have an ability to refinance or reset that. So where I'm going with this is we maybe haven't had the best financing over the last year, but because the entry price was so attractive, we were willing to move forward with those investments, thinking and hoping that there was the potential for even further upside if we could refinance down the road. As we look at assets today and what we're seeing, what is going on the tax side of the equation is a very big deal.
Yeah.
And we invest in gas stations. We have seen a lot of demand start to pick up in this space. Now, it's not going to get to the highs, or when we talk about cap rates, the lower the cap rate, the better. It won't go to those as low of cap rates as what we saw in 2021, 2022, okay?
Yeah.
But things are getting better every day in that space. There's then another factor that's impacting the investment world in general, and also it has a tangential positive impact on us. And it's some of the talk from Trump on 401k and retirement funds and the ability of that to go into private equity or more illiquid assets.
Yeah.
That's a massive pool of capital. It is. And that would be a major tailwind. And I'll just go back again to the fundamentals of a market and how you assess a market. In markets, we talk about benchmark rates. We talked in the beginning about a benchmark interest rate, right? We talk about benchmark risk-free rates, which are tied to interest rates. And then you have a risk premium. You have an additional return element that's directly related to an increased risk profile. Illiquidity and the amount of investors that can access an investment absolutely impacts a risk premium of an asset. If you had an asset that out of 100 people, only 5 of them could purchase, versus another asset that looked exactly the same, but 75 out of the 100 could access. Well, the one that only 5 could access would have a higher risk premium.
Yeah, way more risk.
It would be riskier because you have a finite pool of individuals that could buy that from you when you sell it.
Yeah.
Well, now we're talking about drastically opening up the pool, the buyer pool in these assets and these illiquid assets. It reminds me of years ago when I was in the hedge fund business, and hedge funds started to make their way to the masses, and then you had these illiquid private equity offerings through ETFs and some creative vehicles that were accessible to certain clientele. It really started to open up, and that was exciting, and this is opening it up even more. And so that's going to provide another very positive tailwind. I mean, we've got some headwinds as well to watch out for.
Yeah.
But you're talking about structurally changing the dynamic of the risk premiums of certain asset classes right now for the positive for investors that are holding them today.
Yeah, that makes sense. I mean, when you can add that many, and we're not talking about 75, we're talking about millions of people
exactly
being able to get into, or being able to take their 401ks and push it into real estate private equity. I mean, that's a big deal. And you're right, it does lower the risk, like, because there's more people involved. So they're going to have, they're not going to have as much exposure in that specific, asset. And so it's nice. Like, it really is a big deal.
Yeah.
So.
Yeah, it is. And it's, especially in the beginning, there's just the math of it, of a bigger investor pool that can access this, and so that helps. But then you have the fact that all of these people are probably underweight that asset class, and they're willing to buy with both hands, right? And go in just because they want to have some diversification and new exposure to their portfolio, rightfully so. And so there's some real tailwinds there, and there are parallels that we could talk about, and whether in the stock market, when you have a stock that joins an index, right, and you have index funds that are forced to buy. I mean, there are plenty of examples that we could point to which showcase how this new buyer pool can impact positively or negatively when there's negative repercussion, but definitely impacts the equation, the valuations.
Wow, this is exciting. I guess just one last thing I think I want to ask you about. You brought up, interest rates, which is awesome. You brought up, 401ks, and that's another big plus in the real estate, market. You also brought up how the new tax bill is a big deal for us, and we've talked a little bit about that with some previous guests. For us here at Harris Investment Group, just looking at where the market is and kind of, how we're positioned here, what's the most exciting thing for you specifically with Harris Investment Group and what we've been doing this year?
Well, Bronson, I'm going to flip this on its head because you know how my brain thinks.
I'm trying to keep it out there.
many times I'm thinking about what worries me and what scares me. The risk manager in my head. And what worries me is what opportunities are going to be there in 3 to 6 months. There's a tailwind right now. We are trying to lock down as many deals as we can today because we see the flow of capital coming into this space that is going to rise or create a rise or an increase in valuations and pricing, especially in our gas station portfolio. I think about what we'll be able to buy in 6 months or 9 months at valuations that look attractive because there truly is money that's coming into the space. We see new entrants, new institutional buyers coming into the space. So that's very exciting right now. Although my brain starts to think, forward looking here and come 2026, what will we be buying and at what levels? And we don't know. And hopefully it'll still be a great opportunity. Obviously, for anybody who has a current holding today or who's locking down the current valuations, I think they're going to be very, very happy that they've done that.
Yeah.
And so that's exciting. And I'll just give spend a quick moment on the multifamily space, which obviously is meaningful exposure for us here. And look, I think I've been on a few of these podcasts, and obviously at Harris Investment Group, we do investor updates, and we have annual conferences. And so those who have followed us and have listened to me know that there has been some concern about the valuations in the multifamily space. And although none of us know when the market will start to rebound, I've thought and talked about many times that any type of initial strength because of macro drivers are basically going to be slapped down by a wave of sellers. So if interest rates are positive for the real estate market, I just don't think it's going to help multifamily that much initially because there are a lot of people on the sidelines that want to sell.
Yeah.
And this continues to be the case. We're continuing to see it happen. And oddly enough, if we had more time, it's almost feels like it's still trending negatively to a degree, which doesn't make sense because the underlying dynamics of the market are getting better. Fundamentally things are better, but we have a wave of sellers that are meeting and matching any positivity in the market. This is on the multifamily side, okay? And so it's keeping valuations low. It's starting to create, to me, some exciting opportunities to buy. And so even though today I'm a big buyer in gas stations, as I look forward 3 months, 6 months, I see the tides starting to turn. And I think that, I think we're just going to be talking about a different story here in 3 to 6 months. But look, positive markets can run for a while. If you look at the stock markets, if you see what's going on with different sectors, if you follow the crypto space, as I know you do, Bronson, if you look at AI and some of these trends, you say, wow, these valuations are high, and how could they go higher? But there are some transformational stories out there that do justify over a long-term hold period, a bullishness and a buying appetite by investors. And when you start talking about tax benefits in the gas station space, that's meaningful to investors. That says something, and there's a reason why this story continues to have legs. I just think that the acceleration, the pace will start to slow down. I think it's a positive trajectory for a while here. With the pace slowing down, offset by what happens with interest rates. And if interest rates do drop and financing costs get cut, it's another tailwind to the gas station and to the real estate market in general. So I don't have a crystal ball. I heard MattyP was picking one up, and he was going to
Did you bring it?
help out.
It said ask
Bring it on the back.
Yeah. But you know that we talk about this all the time. If you want to be a smart investor, it's not about predicting the future. You need to understand what drives the markets and what is driving the markets over the near term. That's what you need to focus on, and to read the tea leaves on those 2 or 3 things that are really driving the market. You and I can't predict the future, but we can know what will impact it, or have a really good feel for that. That's what makes good investors. That's what we're looking at here.
Yeah, no, I love that. And I love also, we're seeing a lot of things happening in the multifamily, the commercial, gas station, all these different areas in real estate. And it's like, who can navigate the bumpy water? Because it's going to be a little bit calmer. And when it's calmer, how fast are you moving through that after navigating some bumpy water? And I think that's important as operators. I think that's something that's really telling. And so I like everything that you said. It's true. So, man, I'm excited.
Yeah.
Whenever we got Matt on here, we get excited. He comes over here and tells us, pull out the crystal ball. And
I love Matt's perspective, just given his background and his the way that he leans towards the risk management side. He is always
unique.
looking forward, looking at the future, not stuck in the here and now, but he can, you can kind of see what could come, understanding the market just through his experience, and making plans as we navigate this waters.
So can I give the one cautionary point out there right now? And I think it's all of us trying to interpret the inflation data and tariffs and that impact.
Yeah.
Man, the more I look at this, I just don't get it. I don't understand it. I don't know how to handicap the data.
Yeah.
And we're all hyper-focused on, that PPI and CPI report. We're all focused on things. There is some weakening economic data out there that I think would tend to suggest that even with increases in pricing from tariffs, that it's just not going to cause any domino effect of inflation that would make the Federal Reserve do something that we aren't expecting, increase rates or just keep them at this level. But boy, it's really, really hard to understand some of the economic data and just to understand the sustainability and just think, is this a pattern that we're seeing, or is it one-off? And remind me again when this policy was implemented, and what's the shipping time again, and when does the cargo hit the port and impact this, and am I looking at tire prices and furniture prices versus which are tariff sensitive versus energy prices, which are weakening, which really aren't tariff sensitive, right? And so it's very tricky right now, and I would really caution anybody coming to too strong of a conclusion off of some of this data. I don't know how you have much confidence in really interpreting this, and that's going to be the one uneasy feeling that I think many professional investors will have, is a lack of confidence in understanding that data. We all know, I mentioned you have to identify what are the key drivers in the market, and that's clearly a key driver.
Yeah.
But when you don't know how to interpret it, so what do you do?
Just
so what
there.
do you do? And so that's a tricky thing right now. But look, don't be a day trader, and it'll be fine. Go in this for the mid to long term. Exactly.
Love that. Well, hey, I know a lot of people have questions for Matt Denning here, so make sure you send them to us at contact@harrisinvestmentgroup.com. We'll ask you the questions, and we love having you on because it's a different take than anyone in this building, because of your experience on Wall Street and the market analysis that you bring, the stuff you read, and the things that you're seeing every day. So we just appreciate you coming on with us today and sharing all of that.
Thanks, guys.
It's great.
Yeah, it's great. I think the only thing that could make this better is if I could get a solid commitment from you that you'll go mountain biking with me this month.
I was hoping it was that we'd go grab some ice cream.
We just did that.
Again.
I'll take ice cream. It's not quite mountain biking, but when you're ready, though, I got a bike.
Okay.
It's an e-bike.
It's an e-bike.
So it'll be really fun.
I thought we were going to go downhill on these mountains and kind of simulate the interest rate environment, volatility, or whatever it may be.
We can do that too.
We can do that too.
Whatever gets you out on that mountain with me, I'm down for it.
Well, Matt, I've seen the bumps and bruises that you've had and the gashes, and so
it's because I'm clumsy. We'll take it easy.
Your risk analysis.
Take it easy on the old man. Okay, appreciate that. Well, thanks, guys. Appreciate you having me on.
Bronson, hope you find your dad.
He's out there.
The HIG Podcast expresses the views of its participants and may not represent the views of Harris Investment Group. The views discussed are subject to change without notice. The HIG Podcast has no duty or obligation to update the information contained herein. It should not be assumed that past investment performance discussed is an indication of future results. Wherever there is the potential for profit, there is also the potential of loss. This is the very nature of investing. The HIG Podcast and its affiliates do not provide tax, legal, or accounting advice. The information shared on this podcast should not be construed as an offering, advisory service, or investment advice. Consult your own tax, legal, and accounting advisors before engaging in any transaction. This podcast, including the information contained herein, is the sole property of Harris Investment Group and may not be copied, reproduced, republished, or posted in whole or in part without the prior written consent of Harris Investment Group.